So Lawrence Kimathi, thank you so much for your time. This earnings cycle, the full year earnings cycle in the banking sector has been characterized by what I'd call the return of the dividend. But looking at what KCB has proposed, 2 shillings final dividend, the interim is about 1 shilling. If you work out the dividend yield is coming to about 7%. That is significantly below your competitors. Also, the payout ratio has been slashed a bit. Are you quite comfortable that what you've given shareholders is a compelling return?
Yeah, Julian, I mean, I'm sure most shareholders would have expected a bit more, but you know, I think our work as management and the board is to have a good outlook. So given what's going on in the world today, geopolitical issues, you know, COVID is still not really fully gone. We've got elections coming up this year. We've got, you know, a very big growth agenda, both organically and inorganically. We felt that 3 shillings in total payout per share was a good balance to, you know, give some returns to the shareholders, while at the same time protecting ourselves and, you know, giving ourselves, you know, that sound springboard to fund our growth.
All right. So when competitors are playing in a dividend yield in the 10s now, and KCB is coming in about 7%, I mean, how do you feel about that?
It's a timing issue. That's what I would say. I mean, if you look back in 2019, our dividend yield was much better. We were paying. We paid the highest dividend we had paid, and actually the highest payout as well. But at that phase, we were looking at things in a different lens. We felt we could be able to sustain our organic growth and, you know, basically the strategies we had deployed. A lot of our competitors have gone through 2-3 years of not paying any dividends, while we sustained our dividend payout. We didn't miss a single year even during COVID. So we believe in, you know, just being consistent in paying and also ensuring that we are protecting the future of the bank.
So Lawrence, you and I have had this conversation before around KCB's asset quality, and I think the bank is struggling with that a bit. But looking at the disaggregation of the numbers, do you think you're a bit overexposed when it comes to the real estate side, especially considering the way it is now nudging up in terms of non-performing loans?
Yeah, I think yes, we are, and we have said this before. We are a bit overweight in the housing, you know, commercial mortgage housing, a bit overweight on construction, especially infrastructure, roads, with the contractors, and hospitality as well. And those, unfortunately, are the sectors that have really been taken a while to recover from COVID. They were the worst hit, and they're taking a bit longer. I must say that some of the hospitality customers we have are back. They're servicing, meeting their full obligations. So, you know, you'll have a few, maybe based on location, based on the brand that they have, that you know, are giving us a bit of a worry. And hence the reason we decided towards the end of the year, it's been 2 years, we've given the support we can, let's look at this differently.
Okay. And still on asset quality, then looking into 2022, do you see yourselves recalibrating your appetite in some of these sectors?
Yes. Actually, we already started in 2021. So our exposure, our appetite, writing new loans on those sectors had really reduced.
So still on the asset quality now from a subsidiary standpoint, and I want us to remove South Sudan and NBK because definitely they are outliers. I was a little surprised looking at the BPR numbers that it is at 7.5% coming second to Kenya. And what immediate steps are you taking now to bring it closer to what we are seeing in Uganda and Rwanda?
Yes, so for BPR, it's actually almost the same as a Kenya story. It's 2-3 big accounts that are bringing that number to 7.5. When we, you know, did our due diligence and were negotiating with the sellers, we brought that up and did tell them, you know, to take full provision and ensure that you know, they graded it appropriately. So we are taking steps to ensure that recovers. As you know, Rwanda has been from an economic point of view during COVID and a lot more stringent lockdowns especially in Kigali. We are seeing that has started opening up now. So we expect those accounts, which are mostly in the commercial real estate side sector should start picking up.
So, Lawrence, the corporate bond market is back, and I've done a bit of market sounding. I'm reliably informed that KCB plans to come to the market with a green instrument. Can you give us some indication as to when you intend to do this and what sort of ticket size you will be looking for in the market?
Yeah, we have been looking at a green bond locally. We are still at very, very formative stages of that conversation, speaking to advisors, just to understand, what would be the market appetite, at what rate would the market expect a green bond from, an entity like ours to pitch at, and then, we take the decision. So it's something that we are looking at. If we go to the market, it will not be anything below $100 million. So that will be the bare minimum.
From a revenue mix standpoint, not just KCB, the entire banking sector is grappling with how to lift its non-funded income. Could you give us some of the strategies that KCB now wants to adopt to ensure that the revenue mix is becoming a lot more balanced than what we are seeing right now?
So the industry, you're right, let's start with the industry on the non-funded side, is really taken a hit in the last 2 years. And the big contributor for that is the bank to mobile wallet transactions, which are zero rated. The regulator has asked us to do that to support COVID as part of the COVID support measures. That continued into 2021. So we are in constant conversations with them, and we are suggesting solutions on how to ensure that we support digital payments or digital transactions, whilst at the same time also trying to monetize on the investments that most of the banks have done. That said, coming now to us as KCB, our performance on non-funded also has not been as strong. In fact, when you compare us with the peer banks, the 5-6 peer banks, we lag behind. We actually lag. We are the last in terms of performance, and that's something that we have identified. We've brought in advanced analytics. They're really helping us focus on how we go to market, how we discuss with our customers, so that we're not leaving our pound of flesh on the table. You're looking at a holistic solution to our customers, which covers both balance sheet, funding, and also other transactional solutions that we can give them.
Lawrence, let's close by talking about the risk pricing model. Yesterday, the group CEO, that's Joshua Igara, indicated that by end of next week, you should be getting feedback from the market regulator. I'm curious to know, what bandwidth do you see for growth of your loan book when you transition into a risk-adjusted regime of pricing?
I would say maybe about 200 basis points in terms of additional growth, because of risk buckets that we are currently not catering for, because we cannot price for that risk. So I would see our loan growth, if we get our approval as per the framework that we propose to the regulator, we see ourselves being able to grow our loan book overally as a group by another 200 basis points. So we've given an outlook of 15. We'll be looking at around about 17. But remember also, this doesn't come in as a bang. It is a gradual growth to lift ourselves.
And now, Lawrence, to my very final question. The risk environment is evolving significantly. How are you seeing the spillovers from what you're seeing between Russia and Ukraine to your business, and how are you circumventing this?
I would say it's and maybe using early days is not exactly the right phrase. I don't have any other. We've seen the sanctions. We've seen the impact on oil. Surprisingly, oil crashed again. So it hit 130, came down to below 100. We've seen the impact of our exporters. I didn't know that Russia is one of our biggest markets for flowers, and that came out with this crisis. I say it's early days because the full impact into the economy will be a lag. So are we hopeful that this impasse might be resolved sooner? We've got to be hopeful. It cannot continue like this, for very long. And if that then does happen, then the impact to us, especially in the region we operate in, is not going to be as significant. If it's prolonged, and it goes into full-scale war, then your guess is as good as mine in terms of what the future will hold.